Thank you for joining the Worldwide Healthcare Trust update call. My name is David Harris, and I'm part of the Frostrow Capital distribution team. Worldwide Healthcare Trust aims to invest in the global healthcare sector with the objective of achieving a high level of capital growth. The aim this afternoon is to provide a short, sharp update on the sector and the Trust strategy before we move to a brief Q&A session. You can ask questions at any time during the presentation using the Ask a Question button at the foot of your page. We will look to address any unanswered questions post-event. Worldwide Healthcare Trust is $2 billion plus strategy and is currently trading on a share price discount of around 9%, well outside its long-term range. The strategy's 10-year share price total return performance of 318% remains the best in its peer group. We will shortly hear from the portfolio managers Sven Borho and Dr. Trevor Polischuk. Both are currently sat in OrbiMed's main office in Manhattan. It has been a punishing 18 months for the healthcare sector, with valuations in some subsectors trading at unprecedented low levels and a large swathe of biotech companies trading below net cash on balance sheet. Despite these falls, innovation in the sector remains robust, with record numbers of drug approvals and novel technologies driving R&D pipeline growth. We expect to see an acceleration of biopharma M&A activity, with biotech targets trading at lower valuations and their financing options less attractive. Elsewhere, the Food and Drugs Agency regulatory environment is expected to remain favorable. And with that, I will hand over to Sven and Trevor.
David, thank you so much for the introduction. And as David already mentioned, we will focus here really on some of the near-term events in our sector and the last 6 months result. This is not a complete update on the fund like we do at the annual meeting or our annual shareholder call. I will focus first on performance, then Trevor will talk about some of the major themes that happened here in the last few months. And then I will then conclude with the portfolio positioning at the end of the call. Quick update on OrbiMed. There has been no major changes. We have been actually this year quite active on our venture capital side with 3 fundraisers. There have been 3 successful fundraisers. But Worldwide Healthcare Trust, it's our largest fund. It's our flagship trust for the firm. Very, very proud of that fund. And it gets an incredible amount of focus, I think, from the public equity team. Coming to the first half year results, it started out early here in April, May, very challenging. And as you all know, the last fiscal year was a tough period for us, where biotech companies and emerging markets companies severely underperformed. It was a tough performance period for the trust. And, this fiscal year started in April, May, out in a very similar way. But then I think, it seems like biotech had bottomed in June, and we resumed our longer historical trend of really outperforming our benchmark. And here you see for the first 6 months of the year, Worldwide Healthcare Trust was plus 2.8%. And despite the slow start of the year, we outperformed the MSCI Healthcare Trust, which was up 2.1%. And healthcare is typically a good sector to be invested in. And you see here FTSE performance minus 8.3%. So this is a continuation of the long historical trend that healthcare in general outperforms the broader market. Obviously, the British pound weakness has benefited the trust. Most of our holdings are, many of them are US dollar nominated. So we had a good currency gain there as well. In local currency, in US dollars, the performance is like minus 12%. The MSCI was down minus 13.4% in the first 6 months of the year. And here I mentioned already on page 6, the first 2 months, it was tough first 2 months, April, May. This was just a continuation of what we had seen in the third quarter of last year, fourth quarter, and first quarter of the calendar year. So really tough period. We had big underperformance early on, again, from the biotech sector. Emerging markets was quite tough as well, while the bigger pharma companies, they held in. But then you see here our performance from May 31st till the end of the first half of the year. So we had a very, very strong gain, plus 11%, which far outpaced the MSCI Worldwide Healthcare Trust of plus 2.3%. And here, on page 7, you see the breakdown by subsectors. Biggest performers, even after the slow start here in April, May, was the biotechnology sector. This was positive 600 basis points coming out of biotech. Big leaders there were like 2 takeout names, Global Blood, which was taken out by Pfizer, and Turning Point Therapeutics, which was taken out by Bristol Myers. Other big biotech gainers were Vertex and BioMarin. Services sector was very strong as well. We have 2 large holdings in United Health and Humana. They performed really well as well in the first 6 months. Japan was surprisingly strong. 2 of our holdings there, Eisai, had some really good data on an Alzheimer's disease drug, and then Daiichi as well, launching a major new product, had some positive performance here. And you see here some of the negative subsector, China, pharma, and medtech. But this was really market related. For example, medtech, the worst performing subsector, negative performance was like over 200 basis points there. But our fund holdings, they were down 11.8%, versus the benchmark in medtech was down 15.8%. So you see the big swoon in medtech was really market driven, and we're still quite optimistic here about many of our medtech holdings. Here page 8 shows our share price chart for the Worldwide Healthcare Trust. And typically when we pick stocks, we like a stock with great fundamentals, but we like it as well, when the stock price charts look strong, where it pulled back to a major uptrend line. And I would say Worldwide Healthcare Trust perfectly qualifies there. Trevor will tell you a little bit about the fundamentals, and many of them have changed for the healthcare sector. So fundamentals are really strong. And here, looking at the chart, we are at our 10-year trend line. And David mentioned as well a very important point. Given a very, very volatile market backdrop, our discount has actually widened a little bit. We're trading now 9% discount, which is higher than some of the historical averages. We do want to go back to trading at parity or a slight premium like we did from 2017 and 2021. And have you seen some of our press releases here? We have been actually active, buying back shares in the Worldwide Healthcare Trust as well. So we do want to actually narrow the discount back to historic norms. Page 9 shows you, our 27-year historical track record. And here again, I think a really important point is you want to be invested in the healthcare sector. You see here the gray line, the MSCI Worldwide Healthcare Index has been very, very good sector to be invested in for a long term. It beats typically the broad market averages. And here, the Worldwide Healthcare Trust, I think we have shown over the years that we can beat the very, very strong benchmark, and that we can add value as portfolio managers. And with that, I will hand it over to Trevor to talk a little bit about our investment themes.
Great. Thank you, Sven, and good afternoon to everybody on the call. We certainly appreciate your time today. Some of the things that I will discuss in this part of the presentation include many of the overhangs in healthcare that we do see lifting now. I will touch a little bit on M&A, which has clearly been a rallying point for the sector. I would like to discuss some of our optimism for a continued rebound in biotech, but really try and focus on some of the innovation that we've been seeing in healthcare. But starting with some of the overhangs, and almost for sure, the biggest overhang on the sector has really been the ongoing threat of prescription drug price reform here in the US. And this has really been an overhang on the group since early 2021 when Joe Biden took office, took the White House, Democrats gained control of the Congress. And actually, this has really been an overhang for almost 30 years. I mean, Sven and I have been talking about this, it seems like the entirety of our careers. We were optimistic last year there would be some resolution to this, but there wasn't. But now this year, things have changed. And with midterm elections looming here in the US, the Democrats floated a new slimmed down bill called the Inflation Reduction Act of 2022. This did garner broad Democratic support, passed successfully through Congress, and focuses on a number of things, including drug price reform. And in that bill, importantly, there's three components on drug pricing. First, drug price cap inflation. This requires companies to pay rebates to Medicare if they increase drug prices faster than inflation, or face penalties for doing so. We think this legislation is absolutely neutral. Price is no longer a revenue driver for the biopharma industry, and it hasn't been for years, despite headlines to the contrary. The Part D redesign, part number 2, this is a clear positive for both patients and the industry alike. This provides additional funding to limit out-of-pocket spending by seniors who are on Medicare. And this totally increases affordability of drugs and should increase the utilization of drugs as well for many medicines. So therefore, we think that is a positive as well. But finally, this new bill included a framework for negotiating drug prices for Medicare drugs. On the face of it, this is negative for the group, but, and this is very important, does not take effect until 2026. It only focuses on medicines that are at or near the end of their exclusivity period. Only up to 10 drugs can be negotiated per year. We still don't know exactly where the discount pricing will net out versus rebates that are already offered, but there's one estimate that we've come up with that suggests the incremental impact may be only about $40 billion across the first 6 years of the rollout. So we think this is a very manageable, low single-digit top-line impact to the collective group. So while maybe not a best-case scenario, we think the overall impact to the P&Ls across the industry will be very manageable. And really, hopefully, the issue of drug price reform can begin to dissipate as an overhang on the group, which should be really good for the sector as this risk is now behind us. The FDA actually has been another perceived overhang on the sector for a couple of reasons. One, there's been no appointed commissioner throughout all of last year. And two, there was a perception that the FDA was so focused on all things COVID that their basic mandate, which is approving new, safe and effective drugs for the public, was completely being ignored. But I think these two sort of issues can be put to rest. First, the idea that the FDA was this rudderless organization due to a lack of commissioner. Well, we just had a new commissioner appointed right at the beginning of the fiscal year. Dr. Robert Califf is a world-renowned cardiologist. He's actually been a commissioner previously under Obama, but most importantly, he's viewed as very industry-friendly. He's a known quantity. I think this is positive for the FDA and for the sector. And secondly, and perhaps more importantly, you can see in this chart here, we have not seen a material slowdown in new drug approvals. In fact, the past 5 years represented by this red box here have been the most productive in the agency's history, including this past year. So we think this investor perception that the FDA is going to and has already improved immensely, and this overhang will continue to alleviate in investors' minds. I think this is an important consideration for the healthcare sector. M&A, Sven and I are always optimistic about the possibility of M&A in the biopharma space, but 2021 was a down year for M&A. There's always ebbs and flows that impact the pace of M&A at any one time. But if you recall some of the earlier calls that we had this year, we talked about how much the profound messaging was coming from large cap executives about business development during the last quarterly calls, that they want to do deals, they have to do deals, they have cash to do it, they have the balance sheets to do it, they have holes in their pipeline needs filling, patent expirations looming. This is all true, but I don't recall ever so much table pounding before by these executives. But finally, all of that talk has turned to action. We've had a real inflection in M&A over the past quarter that has continued now into October. I think we're tracking at near record pace for deals through year end. Some of the highest annual average deal value in recent memory. We're seeing many triple digit premiums being paid. Overall, we think this is a harbinger of things to come. This has been a real rallying point, especially in biotech. And we've seen in the past that M&A, when it occurs like this, can float all boats. And that's exactly what we've seen thus far. This rash of M&A, if you will, has pushed small cap biotech really off the bottom. This chart shows the XBI and this significant, more than significant, this historic drawdown that we've seen since the beginning of February of last year that Sven and I have talked about. The XBI has now moved with this M&A catalyst off the bottom as much as 50% over the past 4 months. It's given back a little bit. There's been some recent volatility, but there are many signs now that we're past the turn, but there's a long way to go to get back to where we were. And quite frankly, there's been a precedent for this. Historically, whenever we've seen these macro-driven or fear-driven material drawdowns, they've all been invariably followed by very strong recoveries. M&A is more often than not the key trigger, followed by perhaps a short squeeze, but then even more importantly, followed by a new appreciation for the fundamentals of this group and the innovation and value creation that it offers. In other words, the catalyst-driven strategy, which is a real hallmark of us here at OrbiMed, really comes back into vogue. And we think this can continue as well. Why is that? Innovation, which I think is the real pillar of our positive investment stance in healthcare, is in a golden era. And it's really incredible across disease states, across technologies, across the explosion of druggable targets, thanks to the massive impact that this innovation revolution has really had in healthcare. And as I mentioned, I believe innovation will continue to be the #1 value driver for almost all of healthcare. And the state of the innovation is very strong within the industry. This slide shows some of the things that we're working on, some of our deep dive work, if you will, in trying to identify what we think is going to be the next big thing. There's plenty of examples here. Some are in oncology, where there's really been a plethora of innovation, such as antibody drug conjugates. We think some of those can be mega blockbusters in the future. Next generation immuno-oncology agents, as many shots on goal that may help continue to grow that $40 billion plus market. And targeted therapies are really delivering on the promise of increased efficacy, yet better safety in many specific patient populations. Obesity is another area where we're doing some work on. Really incredible advances in drugging different metabolic pathways have created really unprecedented weight loss in obese patient populations. And if these drugs can show they reduce cardiovascular events, increase overall mortality, and provide a benefit there, that would be critical in garnering reimbursement in the future. So we're following that very closely. And of course, Alzheimer's disease. This really continues to be the holy grail, if you will, of the pharmaceutical drug development. I know last year was very controversial for this space, but we have here 3 additional novel drug candidates to report data this year. And into early next year, we've been doing a ton of due diligence here and to see if many of them might have a real clinical benefit. And one just hit last month, an ASI reporting a 27% reduction in cognitive decline. This drug called lecanemab from ASI and their partner Biogen became really the first antibody ever to show clinical and statistical benefit in a full phase 3 registrational trial of early Alzheimer's patients with mild to moderate disease. And this outcome was really unprecedented. And look how statistically significant it was. There's a lot of zeros ahead of that 5 there. It's really incredible too. The benefits were seen as early as 6 months. The benefit continued to get better at 12 months, 18 months, suggesting that the duration of efficacy of this drug in an Alzheimer's patient goes beyond the parameters of this clinical trial. All secondary endpoints were met, and importantly, the drug was shown to be very safe. And remember, the consensus expectation heading into this trial is that the trial would fail, but the opposite happened, and this was a spectacular success story. I was very lucky to be in Japan last month at the time of this data release. I attended the company analyst meeting and press event live in person. And it was very clear being there, the excitement and the pride that the company employees and the executives had over this data release. It was very clear, very palpable. This was a big win for the company, a big win for patients, but also a big win for the sector, as the consensus expectation, as I mentioned, was that this trial would read out negative, and the opposite happened. So with that, I will hand back to Sven to discuss a little bit on our current positioning. Sven.
Okay, thank you, Trevor. One of the big questions what I always ask is like, how are like the bigger macro factor concerns, impacting the healthcare sector? So how is high interest rates, higher inflation, and now like a slowing economy, possibly a recession, going to impact the healthcare stock? And I think what should be comforting to our investors is that typically during this is such an environment, healthcare performs really quite well. Government and private payers, will remain willing to reimburse all of these therapies regardless of the economic climate. At the same time, the users, the patients, the last thing they will cut back in a recession is actually on a life-saving drug. If you have cancer, you will cut back on everything else, but actually on your cancer drug. So if you look back at, the last 4 recessions here, you will see that healthcare actually outperformed very, very significantly the broader markets. And you see here on page 22, in the middle, you see the S&P 500 healthcare. So these are the healthcare constituents of the S&P 500. They far outperformed actually the S&P during this period. And if you go even look further, like medtech, biotech, small cap biotech, large cap biotechs far outperformed even like the average healthcare stocks, and significant outperformance over the broader S&P. And the only other sector which has actually underperformed the S&P there has been managed care. So broadly overall, I think this current environment where we're in bodes actually well for outperformance of the broader healthcare sector. Coming to page 23 with our current positioning, you see here our big overweights versus the MSCI is by far emerging biotech. This is where we have added quite a bit of exposure here earlier in the year. When biotech stocks have been falling, we have been adding to performance, and this has actually paid off here in the first half of the year. Emerging biotech has been by far our biggest positive sector on the back of some of the M&A transactions. So big cap pharma, very meaningful underweight. This was a good underweight versus vis-a-vis our benchmark. But then, medtech, we have a healthy weight in line broadly with the benchmark. but this had been our biggest loser, and this has been actually overall, I think, the toughest sector within healthcare in the first 6 months. Japan, we have increased. We added to some positions like ASI and Daiichi. That was timely despite some of the currency gyrations there. I think our added exposure there. Privates, they're slowly working their way down. We will have as well a couple more possible IPOs over the next 6 months. So I expect our privates line to drift back down to sub 5%. And it's only then where I would really consider to making additional new investments in some private names. So I think over the next 6 months, probably very little activity there. There will be more of IPOs, and then maybe next fiscal year that we will recommit if you see some really interesting opportunities here of some private companies to commit new capital. Page 25 shows you our complete portfolio. You see there are a lot of names in the biotech sector in emerging markets. So those names are typically smaller cap names. That's why they are smaller positions. But you see our top 10 holdings contributed for our 44% of NAV. Our top 30 name are 92% of NAV. So it's a fairly concentrated portfolio. Our biggest names in the portfolio are here: AstraZeneca on the pharma side, 6% of NAV. Bristol Myers, 6% of NAV as well. In the services sector, you see our biggest names here: Humana, 5.1, United Health Group, 2 good performing stocks. And in MedTech, our number 1 name is Boston Scientific. And then you have Intuitive Surgical, which has actually recently moved up close to 4% on the back of a really strong third quarter earnings. In the biotech side, you see some bigger holdings like Vertex and the BioMarin, but then our biggest holding on biotech is our merger basket. It's 5 points of exposure. This has been a very, very good instrument. Almost all of the M&A transactions in the sector, they have been constituents of this basket. There are a couple of handful of names which are on everyone's short list for M&A, and all of those names are in this M&A basket. It's a derivative swaps, but it's just where we are amplifying this M&A trend that we are seeing in the biotech sector. It's been a great instrument for us. And now going here on page 25, which shows you our WWH leverage over time. Right now we are kind of in a relative average leverage, and the reason for, I think, the average leverage is really, markets are volatile. There have been some macro trends which have created volatility, but given our fundamental backdrop, with all of the overhangs clearing, you saw this big pullback in the biotech sector, historic bear market there, and some major scientific advances with a lot of the innovation, a lot of the clinical trial readouts, like on Alzheimer's disease, they have been successful, and there was a consensus thinking actually out there that many of these would be failures. So there are many positive surprises here inside our sector over the summer months, including M&A, and that have been really supportive of the sector. If I would look just from a fundamental basis, I would probably be fully geared. My only hesitation is right now is a little bit the macro backdrop. But given all of those things, I'm really optimistic here about the outlook for the sector. This is a good environment, slowing economy. It's a good setup for healthcare outperformance, and the fundamental themes have been very strong. And most importantly, some of the overhangs, like drug pricing reform, have been lifted. So we are fairly optimistic here, really, an outlook of the year, and we're trying hard, trying to narrow our discount and trying to put here a really positive second half of our fiscal year on the board. With that, I think we are going to open it up to questions, and let me just actually scroll through and see what question we have. I see 3 questions there. David, I think we are open for questions. So I think anyone can really write down the question. We will then answer them as we see them. So let me maybe start with the first question. So first question was, you seem to be more interested in making money from corporate takeovers than scientific risk. Is that fair? It's not quite fair. I think M&A, when you have a major pullback in healthcare, typically the one first indicator of a turnaround is M&A. And we have seen this in recent months that big corporations, they have been stepping up and buying biotech companies. And it's because of the current juncture where we are at, you want to be in names that will be taken out, because I think this is what's going to generate performance here over the next 6 months. Another important thing is the names that get acquired are the most innovative names in the sector. So nobody, typically the big pharma companies, they're not buying value plays. They're buying when they see highly innovative product, which is going to be an important addition to their own product portfolio. So if you are in the most innovative companies, which are having like a major transformative products getting introduced, you will automatically be invested in the sweet spot of an M&A name. So by us being so biased towards emerging biotechnology companies, some mid-cap, SMID-cap medtech companies, we are automatically in the sweet spot for M&A. So you can have it both. You can be actually getting a lot of M&A transaction and being invested in the most innovative companies. Let's see. Second question was, and I maybe answered that one as well, Trevor. So why do you expect mRNA research to fail to find further successful commercial products? Well, this is probably a question related to Moderna and BioNTech and the mRNA vaccines, if I understand the question right. Now, mRNA vaccines have been a very, very important change in vaccine technology. Obviously, for the COVID vaccines, they have been transformative. But I know, for example, in the UK, many people they believe that mRNA vaccine players, they are just like Tesla. And the one thing what I would say there is, like Tesla, what it does to the car industry is basically electric engines. They are like completely changing. They're transformative. Ultimately in the long term, probably everything will be electric engines. mRNA vaccine technology, I would more compare it to a different form of a combustion engine. I think mRNA vaccines will not completely replace traditional vaccines. There is a very important place there. Many of the next generation vaccines will be non-mRNA vaccines. So I would just simply say it's just simply a different variation of a combustion engine. So it's not as transformative as what, let's say, a Tesla and electric engines are. Third question is, why are you optimistic for the medtech sector, and what are the drivers of this? Well, I mentioned before, we like the medtech sector. The reason why we like the medtech sector is you see tremendous innovation there as well. And unlike large cap pharma, you see many times like high single digit top line revenue growth rate for some of the sector stalwarts like a Boston Scientific, which is far higher than most of the large cap pharma companies. And then you have really innovative names like an Intuitive Surgical, whereas the medical robots, which have 15% revenue growth rates. And these kind of high top line revenue growth rates by a really very highly innovative sector. This is why we like medtech in general, and why we see there many times some of the highest growth rate from within the healthcare sector. And this is what we like to see, high top line revenue growth rate, high single digit to mid-teens, leading to mid-teens EPS growth rate. This is, I think, the recipe for success of generating investor returns on the trust of 15 to 20% when you invest in this in such high growth companies. And that's why we like medtech. It's a poster child for this recipe for success. Trevor, maybe I give you the fourth question. Given the recent strong performance following strong setbacks in the sector, can we expect leverage for the trust to increase meaningfully?
Sure. Thanks, Sven. As Sven discussed previously in the presentation, we continue to use leverage in a very tactical fashion, increasing, decreasing where we see most appropriate. And as Sven echoed, and I think as your question sort of implies, we are very bullish now from sort of a bounce perspective, given some of the overhangs lifting in healthcare, what's happening with M&A, biotech lifting, and the continued focus on innovation. But the only caveat we do have right now is a little broader concern about the macro environment, broad market environment. But otherwise, yeah, we are optimistic, and I think we can expect leverage to increase to reflect our bullishness going forward.
Trevor, maybe you take the next question as well. What are the return prospects for various team in the fund over the next 12 months?
Well, really, I think this is a question that is really all about innovation. And maybe I'll cheat a little bit and just bring you back to this slide here, which highlights some of the things that we've been actively working on. I think a critical theme in the portfolio is certainly oncology across large cap pharma and the particular holdings that we have, across emerging biotechnology stocks and some of the holdings we have, as well as Japan pharma as well. I discussed ASI, Alzheimer's. That is a critical theme going forward. That's been partially de-risked with positive phase 3 data. That was highly efficacious, very safe. I think the regulatory path there has been de-risked. Now we're going to look towards a little bit of the commercial opportunity and how well ASI and their partner Biogen can execute on that. There'll be a couple more trials read out here in the near term. Roche will have an important readout in November, they've articulated, and Lilly with their antibody will report out sometime early next year. But coming back to oncology, one of the really important themes that I've just touched on ever so briefly was antibody drug conjugates. And maybe the prototypical example right now is a drug called Enhertu. This was developed by a Japanese company called Daiichi. They've partnered this ADC with AstraZeneca. We've seen multiple data sets, but two of them in particular really stand out, which is basically the use of this drug in the treatment of metastatic breast cancer in either women who express high levels of a protein called HER2, and now in women who express low levels of that protein called HER2. These two data sets versus either the standard of care have shown amazing efficacy in the reduction of mortality by 72 and 50% respectively in women with this particular metastatic disease in this genetic profile. Everyone now understands this is going to be a mega blockbuster product with sales estimates approaching $10 billion US. But we see a scenario where it can be $15 billion or beyond, not only because of these two indications, but additional indications, either advancing therapy into earlier disease, away from stage 4 in the metastatic setting, to frontline or even adjuvant therapy. And there also might be really important utility as in some lung cancer patients as well. Again, just sticking with oncology, a really important theme is in immuno-oncology. We're seeing next generation targets. And for those of you who don't know, immuno-oncology is very elegant science. These are drugs that target the body's own immune system to stimulate, attack, and destroy cancer cells and getting rid of tumors within the body. This has been a revolution in the treatment of cancer over the past 6 years now. We finally moved on to next generation opportunities that fit within this checkpoint inhibitor pathway. We've had some successes with LAG-3. The next big thing is something called TIGIT. We had an interim readout that slightly missed, but we're going to get an update on that early next year. We're very excited about that. So these are just some of the things that we're working on when we think about sort of the returns going forward. It's really going to be innovation driven across almost the entirety of the portfolio.
Okay, perfect, Trevor. Thank you so much. Next question is, what discount to net asset value are you aiming to get by the end of December 22? You know, e.g., if discount is 9%, what do you actively buy back by the end of the year, Primo? Look, you can see from our press releases, we have been quite active here during the summer months. If I understand from our broker is the average discount for closed-end trust have significantly widened this year. They are now on average 14%. We as a fund have a policy then when the discount is greater than the 6%, that we will be active in buying back our share. We aim for less than 6%. We would like to be, where we were the previous 5 years, that we are trading, close to parity. That is the aim. But look, it's an open marketplace. We cannot guarantee it, where we will end up. But as you can see, we have been active, and I think some of these share buybacks are accretive to our fund shareholders.
Sven, if I can just add there that the aim, of course, is always to get to a premium and grow the company through secondary share issuance. So we don't want to be on a discount as a company. Clearly, that's not in our interest. So we will look to tighten it through a combination of active marketing and the active buyback that Sven has mentioned.
So next question is, do you plan on expanding your private equity exposure? I mentioned it already. We are. It has reduced because we had some additional IPOs. It is 7.5%. It's on its way getting below 500 basis points, and it's only approximately that level that I would consider right now to add to it. I think right now, the biggest opportunities, the biggest dislocations in our sector are in small and mid-cap biotech stocks, which are trading many times below their cash on their balance sheet. So new funds are really added to areas of biggest dislocations. And right now, it is not private equity. But as I mentioned before, I could easily see, in next fiscal year that we would add like 1 or 2 or 3 high promising opportunities in private equity, but not in the near term. Trevor, next one. What is your outlook for FDA approvals in light of the recent pickup in recent years?
Oh, yeah, that is a great question. And thanks for that question, Anthony. When we think about the FDA, I think a critical message that we try to convey is that despite all of the work that the U.S. Food and Drug Administration has done with COVID, and that includes all the vaccine work and the reviews there, all of the work on the new therapies that have been approved and treatments for COVID-19, as well as the literally hundreds of diagnostics approved. Despite all of that incremental work at the FDA has not become a bottleneck or is not a bottleneck for new drug approvals. They've been able to allocate resources appropriately to not only tackle the COVID issues and the hurdles associated with that, but have continued the ongoing process of FDA with respect to new drug approvals, advisory committee meetings, inspections of manufacturing facilities. That's probably been the most difficult thing for the FDA, especially outside of the country in geographies in which there's border issues because of COVID. And that's really more just isolated now to China, given the lockdown situation there. But otherwise, our outlook for the FDA is they will not be the bottleneck for new drug approvals. It's just going to be the industry and the innovation going forward, and we're very positive on that looking ahead.
Okay, we have 3 more questions. 2 are related to mRNA vaccines, very interesting, and third one is on obesity on obesity treatment. So I take the mRNA, and Trevor, you do the last question on obesity treatment. So 2 more questions here. So mRNA may not be revolutionary, but do you have a view that the science won't work in new areas outside COVID? And then this, related question, following your comments about mRNA tech, what vaccine technologies would you say are more transformative in that case? And if mRNA is able to break through into unserved areas like cancer, isn't there an opportunity? And it's very interesting. I get so many questions all the time from out of the UK all the time about mRNA vaccines. So look, I think mRNA technology is important, you know, and it's an important evolution, but not a revolution in vaccine technology. You know, the easy pickings was COVID-19 vaccines. But you see, for example, RSV vaccines, you know, the traditional vaccines are very, very strong. The data are strong, and possibly mRNA vaccine data are just on par, you know, with the traditional technology. Same thing with flu vaccines. You know, you have seen some initial data on mRNA flu vaccines. And I think the vaccine market will continue to be split between traditional vaccines and evolutionary vaccines like an mRNA vaccines. It is a much more difficult question. How will mRNA technology work outside of it? Will it work in cancer? We will see some initial data in, you know, probably the lowest hanging fruit in cancer, which is melanoma. But I think as we progress in the other oncology disease indications, or orphan disease indication, it will become much more difficult, and it's not as clear that mRNA vaccine technology is so easily transferable to, I think, into the oncology space. So I would be a little bit more careful about that. You know, I think a lot of investors, they have gotten so excited about, you know, the revenue coming from COVID-19 vaccines, and they just simply translate that, oh, it will happen in every single area. And I think there the bar is very, very high. And it is not yet clear from the data what BioNTech or Moderna have produced that we will see similar success stories there. And, you know, don't forget, you know, Moderna and BioNTech, very, very high market caps. And they have to make up actually for, you know, with COVID-19 fading over the coming years. So I would be cautious there and, you know, look at the fund. I think we have no exposure to BioNTech and Moderna right now. And that's our assessment on the relative value, you know, of the companies. You know? So I think they are definitely important evolutions in vaccine technology. There is no question about it. But I think the questions are right. It's maybe not quite a complete revolution like a Tesla with an electric engine completely replacing the combustion engine. And I know, Trevor, you know all about the obesity market. It's a big theme for you. So you take that one.
Yes, absolutely. Thanks, Sven. So definitely obesity is something that we just highlighted in part of our deep dive work that we've been doing. And the size of the market could potentially be huge. I mean, if we take a step back and just think about the patient prevalence, the number of obese people, typically defined by a BMI or a body mass index of 30 or greater, is up to 70 million people just in the United States alone. That's a staggering number. So the potential market size is very big. But the second half of your question is perhaps the more important one. Who is going to pay for these drugs? Well, this is where we come to the next hurdle. I think to get full reimbursement, at least in the US and probably in other single payer environments, the companies involved are going to have to show that these drugs reduce cardiovascular events, improve mortality benefits in an unequivocal fashion. Those trials are ongoing. They've started. They're a little bit early. The first one that started is by a company called Novo. They had an interim look at that first cardiovascular outcome study, and that interim look failed to show a statistical separation between patients on drug and those taking placebo on that cardiovascular benefit. That doesn't mean there won't be one. I'm just suggesting that the hurdle is very high to get proper and full reimbursement for these drugs going forward. So this is why our pencils are sharp. This is why we're doing the work now, trying to understand these clinical trials, try to understand the powering, the patient populations, because the weight loss that we're seeing is really incredible. Upwards of 20% weight loss in obese patients, and even next generation drugs are already in development, even though we're just on the precipice of real material breakthroughs, and the next generation drugs might approach 25% weight loss. So we're continuing to do the work. So I guess stay tuned for obesity.
Okay, that brings us to the end of our Q&A session. Let me hand it over to David for some concluding remarks.
Sven, I'll keep this brief. Thank you again for your time, and thank you again for everyone else's time. If there are any follow-up questions, please email distribution@frostray.com, and we will come back to you in due course. Have a good evening. Thank you.
All right.
Thank you so much for joining.